Before we start, a quick but critical disclaimer. I am not a licensed financial advisor or insurance agent. This video is for educational and entertainment purposes only. The information provided is based on extensive research and personal experience, but it is not a substitute for professional financial advice. You should always consult with a qualified, licensed professional to discuss your specific circumstances before making any insurance decisions. Alright, now let's get into it. I will never forget the first car insurance bill I ever received. It was a physical gut punch. I was 18 driving a 15-year-old Toyota Corolla that was probably worth less than the gaming console in my living room. I'd saved up for months to buy that car, and I was so proud of it. Then the bill came in the mail. $280 a month. My jaw hit the floor. That was over $3,300 a year. For a car worth maybe $2,000. Felt like a mistake. Felt like a scam. Felt like I was being punished for simply being young. And you know what? I was. And you probably are too. The entire auto insurance industry is a machine, a complex algorithm designed to calculate risk. And if you are under the age of 25, that algorithm flags you with a giant, flashing red light that says, danger, high risk. Charge them everything you possibly can. It doesn't care that you're a safe driver. It doesn't care that you've never even had a parking ticket. It looks at your age and it sees a statistic. A statistic that says young drivers are more likely to get into accidents. So you pay the price for every other reckless driver in your age group. You are subsidizing their mistakes. It's a system that is fundamentally mathematically stacked against you from day one. But what if I told you that you don't have to be a victim of that system? What if I told you that you can understand the game so well that you can actually start playing it to your advantage? That's why we're here. This isn't just another video with a few generic tips like drive safe or get good grades. This is a masterclass, a step-by-step blueprint designed to take you from being an insurance company's favorite target to their worst nightmare. An educated consumer who knows exactly what they want, what it's worth, and how to get it for the lowest possible price. By the end of this, you will have the knowledge and the confidence to cut your insurance bill by hundreds, maybe even thousands of dollars a year. That's money for your rent, for your student loans, for your investments, for that trip you've been dreaming about. It's your money and it's time to take it back. So where do we start? We start at the foundation. The absolute bedrock of getting a good deal is understanding what the hell you're actually buying. When an insurance agent starts throwing around terms like liability, collision, comprehensive, and a bunch of numbers that look like a secret code, our eyes glaze over. We just want to get it over with. We nod and say, aha, that sounds fine. And in that moment we lose. They are counting on your confusion. Knowledge is power, and today you're getting the power back. Let's break down a standard auto policy into plain English. Think of your policy not as one big thing, but as a bundle of different smaller coverages. You are the chef and you get to pick the ingredients. First and most important is liability coverage. This is the one part of your insurance that is legally required in almost every single state. Liability does not cover you. It does not cover your car. It covers everyone else. It's your, I'm so sorry I messed up fund. It's broken into two parts: bodily injury liability and property damage liability. Bodily injury pays for the medical bills, lost wages, and pain and suffering of other people if you cause an accident that injures them. Property damage pays to repair or replace the other person's car, or anything else you might have hit, like a mailbox, a fence, or a storefront. Now, this is where you see that secret code I was talking about. You'll see numbers like 25/50/25 or 50/100/50. It's not as complicated as it looks. The first number is the maximum amount, in thousands of dollars, your insurance will pay for one person's injuries in an accident you cause. So, a 25-foot means $25,000 per person. The second number is the maximum amount they'll pay for everyone's injuries combined in that single accident. A 50 means $50,000 total. The third number is the maximum they'll pay for all property damage. A 25-foot means $25,000. So, 25/50/25 is the state minimum in many places. And let me be crystal clear. The state minimum is a financial trap. It is dangerously, terrifyingly low. Imagine you cause an accident and you hit a brand new Tesla. A new bumper and a sensor on a Tesla can cost $10,000 alone. What if you hit a new Ford F-150? That's a $50,000 truck. Your $25,000 in property damage coverage is gone in an instant. And guess who's getting a bill for the other $25,000? You are. Imagine you injure someone and they need surgery. Medical bills can hit six figures faster than a sports car goes from 0 to 60. If your coverage runs out, they can and will come after your personal assets, your savings, your future wages, everything. Getting the state minimum is like going into a sword fight with a butter knife. We'll talk about how much you should have later, but for now, just know that liability protects your financial future from being destroyed by one bad moment. Okay, next ingredient, collision coverage. This one is simple. Collision pays to repair or replace your car if you get into an accident that is your fault. You hit a pole, you rear-end someone, you back into a garage door, collision has your back. Now, if you have a loan on your car or you're leasing it, the bank will almost certainly require you to have this. If you own your car outright, it's optional. This is where your deductible comes in. A deductible is the amount of money you have to pay out of pocket before the insurance company pays a dime. So if you have a $500 deductible and you have $3,000 in damage, you pay $500, and the insurance company pays the other $2,500. The higher your deductible, the lower your monthly premium. It's a trade-off between paying less now versus potentially paying more later. Then we have comprehensive coverage. I call this the Life Happened to My Car Fund. This covers damage to your car from things that are not a collision. A tree branch falls on it during a storm. A deer decides to play chicken with your front bumper. Your car gets stolen. It gets vandalized. A hailstorm makes it look like a golf ball. All of that is comprehensive. Just like collision, it's usually required if you have a loan, it's optional if you own the car, and it also has a deductible. Most people buy collision and comprehensive together as a pair. Next up, a hugely important one. Uninsured or underinsured motorist coverage. This is the what if the other guy is a broke deadbeat fund. Let's say someone illegally runs a red light and plows into you. It's 100% their fault, but they have no insurance. Or they have that terrible state minimum coverage that doesn't even begin to cover your new car and your medical bills. What happens? You're stuck. You could sue them personally, but you can't get blood from a stone. This coverage protects you. It steps in and acts like the other driver's insurance, paying for your car repairs and your medical bills. In some states, 1 in 5 drivers is on the road illegally with no insurance. Skipping this coverage to save a few bucks a month is one of the riskiest gambles you can possibly make. Finally, there's medical payments coverage, or in some states, personal injury protection, also known as PIP. This is the immediate ambulance ride fund. This coverage pays for your medical expenses, and sometimes your passengers right away after an accident regardless of who was at fault. It's designed to get you immediate care without waiting for the insurance companies to fight over who's paying. It can cover health insurance deductibles, co-pays, and things health insurance might not, like lost wages if you can't work. So, let's recap the 5 main ingredients: liability for when you mess up, collision for when you mess up your own car, comprehensive for when life messes up your car, uninsured motorist for when a deadbeat messes up your car, and medical payments for your own medical bills right away. Why did we just spend all this time on definitions? Because this is the language of the game. You cannot win a game if you do not know the rules. And you cannot get a good deal on insurance if you don't know what these coverages are. When you call for a quote, and they ask if you want 100/300/100 in liability, you'll no longer have a blank stare. You'll know that means protecting your future with $100,000 for one person's injuries, $300,000 total, and $100,000 for property damage. When they ask if you want a $1,000 deductible on collision, you'll know that means a lower monthly bill, but you'll need to have that $1,000 saved up just in case. This knowledge turns you from a passive customer into an active architect of your own policy. You are now in control. And in the next part, we're going to take that control and use it to find the hidden discounts that insurance companies pray you never ask about. Think of the insurance world as a giant video game. The monthly premium is the final boss. And right now, you're standing at the entrance to a level filled with power-ups and secret items. These are the discounts. Some are lying right there in the open, easy to grab. Others are hidden behind breakable walls or require a secret code. The insurance companies? They're the game designers. They put the easy ones out there to make you feel good, but they hide the most powerful ones, hoping you'll just run past them. Our mission today is to collect every single one. Let's start with the most obvious power-up, the one designed specifically for you. The good student discount. This is not a small thing. We're talking a potential 10 to 25% reduction in your premium. For a young driver, that could be hundreds of dollars a year. Now the requirements vary. Some companies want a B average or a 3.0 GPA. Others want you to be on the dean's list or in the top 20% of your class. The key is, they will almost never apply this automatically. You have to prove it. So right now, find your latest transcript or report card. If you have the grades, you have the discount. It's that simple. There's also a related discount if you're a student away at school, more than 100 miles from home, and you didn't take your car with you. If your car is sitting in your parents' driveway most of the year, you are a much lower risk. You need to call and tell them that. That's an instant price drop. Next up in the easy-to-grab category is bundling. This is the insurance company's favorite discount to advertise, and for good reason. They want more of your business. If you have renter's insurance, and if you're renting an apartment, you absolutely should. Bundling it with your auto insurance is a no-brainer. The discount on your auto policy is often so large that it makes the renter's insurance practically free. The same goes for bundling with homeowner's insurance if you're living at home. It's called a multi-policy discount, and it's one of the biggest single discounts you can get. While you're at it, if there's more than one car in your household, putting them all on the same policy for a multi-car discount is another massive, easy win. These are the foundational discounts. Getting these 3 good student, multi-policy, and multi-car is like starting the game with a shield, extra health, and a speed boost. You're already way ahead. But now we move into the next level. These are the discounts you have to earn. They require a little more effort, but the payoff is substantial and, more importantly, it's recurring. The first is the defensive driving course discount. Insurance companies love customers who actively try to be better drivers. By taking an approved defensive driving course, you're showing them you're serious about safety. These courses can often be done online in a few hours over a weekend. Yes, there might be a small upfront cost, maybe $25 to $50. But the discount you get can last for 3 years and save you 5 to 10% on your premium. Do the math. If you're paying $200 a month, a 5% discount is $10 a month, or $120 a year. Over 3 years, that's $360 in savings for a $25 course and a few hours of your time. That is an insane return on investment. Now for the most controversial and potentially most lucrative of the earned discounts: telematics. You've probably heard of these. It's the little device you plug into your car, or the app you download on your phone, like Progressive Snapshot or State Farm's Drive Safe and Save. This is the insurance company literally riding shotgun with you. It tracks your driving habits, how fast you accelerate, how hard you brake, what time of day you drive, and sometimes your phone usage. I know what you're thinking: Big Brother is watching me. And you're not wrong to be skeptical. This is a trade-off. You are trading a slice of your privacy for a potentially massive discount. Good drivers can see savings up to 30 or even 40%. But here's the critical piece of information they don't always shout from the rooftops. In many states and with many companies, they cannot raise your rates based on this data. Can only help you. You need to ask this question directly. Can my premium increase as a result of this program? If the answer is no, then you have literally nothing to lose by trying it for the initial monitoring period, which is usually around 90 days. Drive like your grandma is in the passenger seat holding a crock pot full of hot soup for those 3 months. Be the perfect driver. Secure the maximum discount and then lock it in. For many people, this discount alone can be the difference between an affordable policy and an outrageous one. It's a calculated risk on your privacy, but the financial reward can be life-changing. Let's pause and see how this works in the real world. Meet Alex, a 20-year-old college sophomore. Alex was paying $2,800 a year for basic insurance. First, Alex sent in a transcript showing a 3.5 GPA. Boom! The good student discount knocked $420 off the annual premium. Alex was already renting an off-campus apartment and had renter's insurance with another company. By bundling it, Alex saved another 12%, or $285. Then, Alex spent a Saturday taking a $30 online defensive driving course, which netted a 5% discount, saving another $115 a year. Just with those 3 steps, Alex's premium dropped from $2,800 to just under $2,000, a savings of over $800 a year, just by making 3 phone calls and taking 1 online class. But we're not done. We're now entering the final level, the hidden treasure room. These are the discounts the agents don't volunteer. You have to know the secret password, and the secret password is just asking the right questions. This is the land of affinity discounts. Insurance companies make deals with all sorts of large organizations, alumni associations, fraternities and sororities, credit unions, professional groups, even specific employers. Are you a member of AAA? That's a discount. Did you graduate from a specific university? Check if your alumni association has a partnership. Are you a member of an honor society? An engineering club? A nurses association? Do you work for a large company or the government? Make a list of every single group, organization, and employer you are affiliated with. Then, when you're getting a quote, you go down the list one by one. Do you offer a discount for members of the American Society of Civil Engineers? Do you have a partnership with Bank of America employees? Is there a discount for graduates of Ohio State? You will be shocked at how many times the answer is yes. Each yes is another 5% or 8% chipped away from that premium. And the hidden gems don't stop there. Think about your car itself. Does it have anti-lock brakes? An anti-theft system? Daytime running lights? These are all potential discounts. Are you the original owner of your car? That can be a discount. Is your car less than 3 years old? That's a new car discount. Now think about how you pay. Are you willing to pay your entire 6-month premium up front instead of monthly? That can save you a significant amount in installment fees. Are you willing to sign up for auto pay and go paperless? That's another small but easy discount. It all adds up. This is what we call discount stacking. You don't get one discount. You get all of them. Alex, our college student, wasn't finished. Alex was in a National Engineering Honor Society that had a deal with an insurer, saving another 8%. Alex's car had a factory-installed anti-theft system, saving another 3%. By agreeing to pay in full and go paperless, Alex saved another $50 in fees. When the dust settled, Alex's initial $2,800 premium had been chiseled down to nearly $1,600. Almost a 45% reduction. Not by switching companies, not by reducing coverage, but by systematically and relentlessly hunting down every single discount Alex was entitled to. This is the power you now have. You have the map to the hidden treasure. Your job is to go through this list, check off every single discount that applies to you, and prepare to present this evidence to the insurance companies. You are no longer just asking, "How much is it?" You are now declaring, "This is the value I bring as a customer, and this is the price I expect." You've gathered your power-ups. You've equipped your best gear. You're ready for battle. But this brings us to the most dangerous part of the quest, the quote-gathering process itself. This is where most people get lost. They wander into the forest of online quote forms, get bombarded with spam calls and emails, and end up cornered by a pushy agent who sells them a policy that isn't even right for them. There is a right way and a very, very wrong way to shop for insurance. And in the next part, I'm going to give you the precise step-by-step battle plan to navigate the quote-gathering gauntlet, forcing companies to compete for your business on your terms, and ensuring you find the absolute best rate without losing your mind in the process. This is your pre-flight checklist, the intel gathering phase that separates the amateurs from the pros. Skipping this step is like trying to build a house without a blueprint. You might get something standing, but it's going to be crooked, expensive, and fall apart at the first sign of trouble. So, grab a notepad, open a document on your computer, whatever you need to do, because we are building your personal insurance dossier right now. First, let's get the easy stuff. Your personal information. You'll need the full legal name, date of birth, and driver's license number for every single person who will be listed on the policy. This means you and anyone else in your household who might drive your car, even occasionally. Next, your address. And I mean the address where the car will be garaged, which is insurance speak for parked most of the time. Don't play games with this. Using your parents' rural address to get a cheaper rate when you live and park in a dense city is insurance fraud. And it's a fantastic way to have a claim denied when you need it most. Now for the car itself. You need the year, make, and model. But that's not enough. Is it a Honda Civic LX or an EX? Is it the 2-door or the 4-door? The V6 or the 4-cylinder? These details matter. But there's a magic number that cuts through all the confusion. The VIN. The Vehicle Identification Number. This 17-digit code is your car's unique fingerprint. It tells the insurance company everything: the engine size, the safety features, where it was built, everything. Providing the VIN ensures you're getting a quote for your exact car, not a generic estimate. You can find it on a little plate on your dashboard, visible through the driver's side of the windshield, on the sticker inside the driver's side door jamb, or on your vehicle's registration and title. Write it down. This is your golden ticket. Next, your driving history. And I want you to be brutally honest with yourself here. Make a list of any and all accidents, speeding tickets, or any other moving violations you've had in the last 5 years. Include the date and a brief description. You might be tempted to forget about that little fender bender from 2 years ago. Don't. Insurance companies have access to massive databases. They're going to find it anyway. Lying or omitting information on your application is called material misrepresentation. It's another great way to get your policy canceled or a claim denied. Being upfront ensures the quote you get is the price you'll actually pay, not some fantasy number that evaporates once they run your record. Finally, if you have current insurance, find your policy declarations page. You'll want your current policy number and, critically, the expiration date. This is important because having continuous coverage, even if it was under your parents' policy, is a huge factor. A lapse in coverage, even for a day, can flag you as a higher risk and jack up your rates. Okay, dossier complete. You now have all the raw data in one place. This alone will make the process 10 times faster. But information is useless without a strategy. Now we move on to the most important part of this entire process, the part that will save you more money and prevent more headaches than anything else. Deciding what you're actually buying. You see, asking for an auto insurance quote is like walking into a restaurant and just saying, "I want food." You're going to get something. It might be a $5 appetizer or a $75 steak. You have no idea. To compare prices, you need to order the exact same meal at every restaurant. For insurance, this means creating a standardized quote kit with the exact coverage levels you want. Let's build that kit right now. We'll start with the absolute foundation, liability coverage. This is the one part of your policy that is legally required in almost every state. And here's the number one mistake young people make. They think liability coverage is for them. It's not. It's for the other person. It pays for their medical bills and their property damage when an accident is your fault. It protects your assets, your savings, your future wages from being taken in a lawsuit. Liability coverage is always shown as a series of 3 numbers, like 25/50/25. This is the secret code that confuses everyone, but it's actually simple. The first number is the maximum amount in thousands the policy will pay for injuries to a single person. So 25 means $25,000. The second number is the maximum amount it will pay for total injuries to everyone in the other car, combined. So 50 means $50,000. The third number is the maximum it will pay for property damage, usually the other person's car, but it could also be a mailbox, a fence, or a storefront. So 25 means $25,000. Now your state has a legal minimum you're required to carry. And I'm telling you right now, the state minimum is a trap. It's a financial landmine. Let's say your state minimum is 25/50/25. You cause an accident and you total a brand new Ford F-150. That truck is worth $60,000. Your policy pays out its max of $25,000 for property damage. Where does the other $35,000 come from? Comes from you. They will sue you. They will garnish your wages. They will haunt you financially for years, all because you tried to save $12 a month. You tap a doctor or a lawyer in their new BMW, and that $25,000 for their injuries won't even cover the initial ER visit. Do not buy state minimum coverage, ever. For your standardized quote kit, I recommend a baseline of at least 100/300/100. That's 100,000 for a single person's injuries, 300,000 total for injuries, and 100,000 for property damage. This is a respectable level of protection that shields your future from a single mistake on the road. The cost difference per month is often less than a few fancy coffees, but the difference in protection is life-altering. Next up are the coverages that actually protect your car. These are collision and comprehensive. Collision is simple. It pays to repair or replace your car if you hit something, whether it's another car, a pole, or a guardrail. It's for when you are at fault. Comprehensive is for almost everything else. Think of it as acts of God or bad luck coverage. A tree branch falls on your car, it gets stolen. A rock cracks your windshield on the highway. You hit a deer, there's a flood or a hailstorm. That's comprehensive. For both of these, you have to choose a deductible. The deductible is the amount of money you pay out of pocket before the insurance company pays anything. If you have a $1,000 deductible and do $2,000 worth of damage, you pay the first $1,000, and the insurance company pays the second $1,000. It's a simple trade-off. A higher deductible means a lower monthly premium, because you're taking on more of the financial risk yourself. A lower deductible means a higher premium, because the insurance company is on the hook for more. For most young adults, A deductible of $500 or $1,000 is a good starting point. It keeps your premium manageable, but won't bankrupt you if you have to make a claim. For our quote kit, let's write down a $500 deductible for both collision and comprehensive. Finally, there is one more crucial piece of armor: uninsured and underinsured motorist coverage, or UM/UIM. This protects you when you get hit by someone who has no insurance, or who cheaped out and only has that worthless state minimum coverage. If they put you in the hospital, their insurance might tap out in minutes. Your UM/UIM coverage then kicks in and acts like their insurance policy, paying for your medical bills and lost wages. In some states, 1 in 5 drivers on the road is uninsured. Skipping this coverage is gambling that you'll never cross paths with one of them. It's a bad bet. For your quote kit, you should always match your UM/UIM coverage to your liability coverage. So, if you chose 100/300 for liability, you choose 100/300 for UM/UIM. So let's review our standardized quote kit. Liability, 100/300/100. Collision, $500 deductible. Comprehensive, $500 deductible. Uninsured/underinsured motorist, 100 out of 300. This is your new mantra. Every single time you get a quote, online, on the phone, or in person, you will ask for this exact package. This is how you force companies to compete on a level playing field. You can now accurately compare the price from Progressive to Geico to State Farm, because you are comparing the price of the exact same product. You won't be fooled by a company offering a dirt cheap price, only to find out later it was for a policy that barely covers anything. You are now armed and ready. You have your complete intelligence dossier with all your personal and vehicle information. You have your standardized quote kit, your non-negotiable list of coverages that will actually protect you. You are more prepared than 95% of the people shopping for car insurance right now. But now comes the big question. You have your battle plan. Where do you go to fight? Do you go online? Do you call an 800 number? Do you walk into a local office? The arena you choose to compete in will have a massive impact on the price you pay and the service you get. In the next part, we're going to break down the 3 primary battlefields for buying insurance, and I'll show you which one almost always yields the best results for a young adult just starting out. So you're standing at a crossroads, ready to buy your first auto insurance policy. In front of you are 3 distinct paths, 3 different ways to enter the market. Think of them as 3 different types of guides you can hire for a dangerous expedition. Your choice of guide will fundamentally change the journey, the price you pay, and your safety at the end of it. The first path leads you to what's called a captive agent. This is the guide who works for only one king, one kingdom. Think of the big names you see advertised during the Super Bowl: State Farm, Allstate, Farmers. Their agents are captive because they can only sell you products from that one single company. Now, this isn't necessarily a bad thing. This guide knows their kingdom inside and out. They know every secret path, every shortcut, every special discount their specific company offers. If your parents have been with the same Allstate agent for 20 years, that agent knows your family history. They can easily bundle your new policy with your parents' home and auto, potentially unlocking a multi-policy discount. The process can feel comfortable, familiar, and safe. There's a single person to call, a face to the name. But here's the enormous catch, the hidden trap in this seemingly safe path. That captive agent's loyalty, by definition, is to their kingdom, not to you. Their job is to sell you a State Farm policy, period. They cannot, and will not, tell you if a competitor like Progressive or Nationwide could offer you the exact same coverage for half the price. It's like walking into a Ford dealership and asking the salesperson to help you find the best deal on a new truck. They will show you a fantastic F-150. They will tell you all about its features and why it's the best. But they will never ever walk you across the street to the Chevy dealership where a Silverado might be on sale for $5,000 less. They're not being malicious. It's just their job. For a young adult, this is a critical flaw. You are, in the eyes of insurance companies, a high-risk category. A particular company might have decided that they just don't want to insure a lot of 19-year-olds, so their rates for you will be sky-high. The captive agent for that company can't do anything about that. All they can do is offer you the very expensive price their one kingdom has set. This brings us to the second path, the one that is incredibly tempting for our generation, going direct to consumer. This is the do-it-yourself path. You are your own guide. You grab your phone or laptop, go to a website like Geico or Progressive, and you fill everything out yourself. The appeal is obvious. It's fast. It's convenient. You can get a quote at midnight in your pajamas. There are no salespeople, no pressure. You feel in total control. You can pull up 5 different websites and compare quotes in under an hour. And for some people, this can work out. But for a young person buying their first policy, this path is a minefield. The feeling of control is an illusion because you don't know what you don't know. The websites are designed to be as simple as possible, but insurance itself is brutally complex. You'll be faced with a dozen decisions with little to no context. What liability limits should you get? Should you get uninsured motorist coverage? What's the difference between collision and comprehensive? What should your deductible be? The website will have little question mark icons with brief, jargon-filled explanations, but it won't have a licensed expert who can ask you about your life and tell you what you actually need. So you start clicking, and your primary motivation is to get that price at the bottom of the screen as low as possible. You see a drop-down for bodily injury liability, and the options are something like 25/50ths, 50/100, and 100/300. You pick 25/50ths because it's the cheapest. Saves you $12 a month. You feel smart. You just hacked the system. But do you know what 25/50 actually means? It means if you cause an accident, your insurance will pay a maximum of $25,000 for any single person's medical bills, and a maximum of $50,000 total for the entire accident, no matter how many people are hurt. Let's play that out. You're driving home, you glance at your phone for a split second, and you run a red light, T-boning a minivan. Inside is a family of 4. The dad has a broken leg, the mom has severe whiplash, and one of the kids has a concussion. They're all taken to the hospital. The ambulance rides alone could be $10,000. The dad needs surgery. Total medical bills for the family quickly soar past $150,000. Your cheap insurance policy with its 25/50th limit pays out the first $50,000. And then the insurance company wishes you the best of luck, because you are now personally on the hook for the remaining $100,000. The other driver's insurance company and their lawyers will come after you. They will sue you. And because you're young and don't have assets, they will get a judgment against you that allows them to garnish your future wages for years, maybe even decades. Every paycheck you earn will have a chunk taken out to pay for that one moment, that one click you made to save $12 a month. That is the hidden danger of the DIY path. You can, with a few uninformed clicks, accidentally ruin your financial future before it even begins. This leads us to the third path. This is the guide I told you about, the one that almost always yields the best results for a young adult. This is the independent insurance agent. Unlike the captive agent who works for one kingdom, the independent agent is a free agent. Think of them as a professional shopper or a mercenary who works for you. They don't work for State Farm, or Allstate, or Nationwide. They are contracted with dozens of different insurance companies, often a mix of huge national brands and smaller, regional carriers you've never even heard of. Their loyalty is to their client, you. Their job is to take your specific situation, your age, your car, your driving record, your location, and shop it across their entire network of companies to find the absolute best fit. They are the expert guide who has explored all the kingdoms. They know which companies are friendly to young drivers and which ones will punish you. They know which ones offer a great good student discount and which ones have accident forgiveness. When you sit down with an independent agent, you have one conversation. You explain your situation once. They then go and do all the legwork. They fill out all the different applications. They navigate all the different websites. They come back to you not with one quote from one company, but with 3 or 4 of the best options from the entire market. And here's the most valuable part. They can translate everything for you. You can ask them, what does 100/300 bodily injury liability really mean, and why do I need it? And they will explain it just like I did, and advise you on the level of coverage that actually protects your future without trying to upsell you on things you don't need. They get paid a commission by the insurance company you ultimately choose, so it costs you nothing extra to use their expertise. In fact, because they have access to so many more options than you could ever find on your own, they almost always save you money while dramatically improving your coverage. For a young adult, this is a game changer. You're in a high-risk pool, and finding the company that views your specific profile most favorably is the key to getting a fair price. An independent agent is the only person who can survey the entire landscape on your behalf. They combine the personal guidance of an agent with the broad choice of the entire market. You get the best of both worlds. You avoid the limited options of the captive agent, and you avoid the incredible risks of the DIY minefield. So we've mapped the battlefield. We have the captive agent loyal to one company. We have the direct-to-consumer path where you're on your own. And we have the independent agent who works for you. Now that you know where to look for insurance, the next critical step is preparing for the battle itself. Before you ever speak to an agent or fill out a single online form, you need to assemble your arsenal, your personal insurance dossier. There are key pieces of information and specific documents you must have ready. Walking in unprepared is like going into a negotiation without knowing your own numbers. It's the fastest way to get a bad deal, miss out on huge discounts, and end up paying hundreds if not thousands more than you have to over the next few years. In the next part, we're going to build that dossier piece by piece so when you make that call, you are in complete command of the conversation. Let's start with the absolute basics, the foundation of your dossier, your personal information. I know this sounds obvious. Name, address, date of birth. But let's look at why this isn't just busy work. Your address isn't just about where to mail the bill. It's about your zip code. Insurers have mountains of data on every single zip code in the country. The frequency of accidents, the rate of car thefts, the severity of weather claims. Living in a quiet suburban cul-de-sac will get you a different rate than living on a busy 6-lane road next to a major university, even if the two spots are only a mile apart. So have your full correct address ready. No typos. Next, your date of birth. This is the big one for young adults. It's the primary factor that puts you in that high-risk category we talked about. There's nothing you can do to change it, but you need to provide it accurately. A simple mistake of 1 year can throw off a quote completely. And finally, your driver's license number. This is the key that unlocks your driving history. The insurance agent will use this number to pull your motor vehicle report, or MVR. This is the official record from your state's DMV that lists any tickets, accidents, or points on your license. You need this number handy, and you need to be prepared to talk about what's on that report. We'll get to that in a minute. So step 1 of the dossier, name, full address, date of birth, and driver's license number. Write it down on a notepad or in a digital document. Simple, clean, and ready to go. Now let's move on to the star of the show, your vehicle. This is where the details matter, and where you can either save a fortune or cost yourself one. First, the basics: year, make, and model. A 2018 Honda Civic. A 2021 Toyota RAV4. Easy enough. But we need to go deeper. You need your car's vehicle identification number, the VIN. The VIN is like a social security number for your car. It's a unique 17-digit code that tells an insurer everything specific about your exact vehicle. Not just that it's a Honda Civic, but that it's the EXL trim model with the upgraded engine and the advanced safety package. This is crucial because different trim levels have different repair costs and different safety ratings. You can find your VIN in a few places. On the driver's side dashboard, visible through the windshield, on a sticker inside the driver's side door jamb, or on your vehicle registration and current insurance card. Don't guess. Don't say, "I think it's the sport model." Go find that VIN, write it down, and double-check it. This single piece of information prevents any ambiguity and ensures your quote is for your actual car, not a base model that will result in a surprise price hike later. Next on the vehicle checklist, the odometer reading, a rough estimate of your car's current mileage. This helps the insurer understand the car's current value in wear and tear. And tied to that is the vehicle's primary use. You'll be asked this, so you need a clear answer. Is this car for commuting to work or school? If so, what's the one-way mileage and how many days a week do you make that trip? Is it just for pleasure, weekend trips, errands, seeing friends? Or is it for business, like making deliveries or driving for a rideshare company? Be honest here. Lying about your commute to get a lower rate is insurance fraud. And if you have an accident on your way to work after saying you only use the car for pleasure, your claim could be denied, leaving you with a massive bill. Calculate your estimated annual mileage. A good rule of thumb is to take your weekly mileage and multiply it by 52. The national average is around 12,000 miles a year. If you're significantly higher or lower, it will impact your rate. Now, a critical question. Who owns the car? Is it financed, leased, or do you own it free and clear? If you have a car loan or a lease, the bank or leasing company technically owns your car until you pay it off. They have a vested interest in protecting their asset. This means they will require you to carry not just liability insurance, but also comprehensive and collision coverage. They will also need to be listed on your policy as a lien holder or loss payee. This ensures that if the car is totaled, the insurance check goes to them first to pay off the loan. Have the full name and address of your lender or leasing company ready. If you fail to do this, you could be in violation of your loan agreement. Getting this right from the start saves you a massive headache down the road. Finally, for the vehicle, let's talk features. Specifically, safety and anti-theft features. This is free money you might be leaving on the table. Make a list of every safety feature your car has. Does it have anti-lock brakes? Most cars made after 2012 do. Does it have daytime running lights? An automatic emergency braking system? Lane departure warnings? How about anti-theft? Does it have a passive alarm system, one that arms itself automatically when you lock the doors? Does it have an active alarm you have to turn on? Is there a vehicle recovery system like LoJack installed? Etching on the windows? Don't just assume the insurance company knows what your VIN tells them. List these out. When you're on the phone, you can say, I'd also like to make sure I'm getting discounts for my anti-lock brakes, daytime running lights, and my car's passive disabling alarm. This shows you've done your homework, and you're not someone they can just rush through a generic quote. Okay, we've covered you and your car. Now let's talk about everyone else. The third section of your dossier is driver information. You need a list of every licensed driver in your household. Your parents, your siblings who are old enough to drive, even a roommate. Insurance companies operate on the principle of permissive use, meaning your policy generally covers someone you give occasional permission to drive your car. However, anyone who lives with you and has regular access to your vehicle needs to be listed on the policy, either as a driver or as an excluded driver. If your 19-year-old brother lives with you, the insurer assumes he might drive your car at some point, and they will want to factor his age and driving record into your rate unless you specifically exclude him in writing. So have the name, date of birth, and license number for every driver in your home ready. This is also where you need to be brutally honest with yourself about your driving history. The insurer is going to pull your record anyway, so you gain nothing by hiding that speeding ticket from 2 years ago. In fact, it hurts you. It makes you look deceptive. Instead, own it. Have a list of any and all accidents, claims, or tickets you've had in the last 5 years. Know the dates and the general circumstances. When the agent asks, you can say, yes, I had one minor fender bender in March of 2022. It was a low-speed backing incident with no injuries, and a claim of about $900 was paid. This is infinitely better than saying, no, I'm a clean driver, and then having them come back and say, well, our report shows an at-fault accident. By being upfront, you control the narrative. And a huge one. Have you had continuous insurance coverage? A lapse in coverage, even for a few weeks, is a major red flag for insurers. Tells them you're a higher risk. If you've been on your parents' policy, that counts. Have the name of that insurance company and the policy number. Proving you've been continuously insured can save you a significant amount of money. Finally, we arrive at the most important part of your dossier. This is the section that separates the rookies from the pros. I call it the discount dossier. This is a checklist of every possible discount you might qualify for, and it's your job to hunt them down. First, academic discounts. Are you a full-time student with a B average or a 3.0 GPA? If so, you need a copy of your most recent transcript or report card ready to send as proof. This discount alone can be worth 15 to 25%. It's huge. Are you a student living away at school more than 100 miles from home without your car? That's another massive discount. Next, have you completed a certified defensive driving course? These often cost between $25 and $50 online and can knock 5 to 10% off your premium for 3 years. The math on that is a no-brainer. Do the course, save the certificate, and claim the discount. Then, think about affiliations. This is the hidden gem of insurance discounts. Are you a member of a specific credit union, an alumni association, a fraternity or sorority? Certain professional organizations like for nurses or engineers. Even some large employers have partner programs with insurance companies. Brainstorm every group or organization you belong to. A quick Google search for your university alumni insurance discount or your employer affinity program can uncover savings you never knew existed. And the king of all discounts, bundling. Do you have a renter's insurance policy? If you don't, you should. It's incredibly cheap, often less than $20 a month, and it protects your stuff, your laptop, your TV, your clothes from theft or fire. When you bundle a renter's or homeowner's policy with your auto policy from the same company, the discount on your auto insurance can often be so large that the renter's policy is essentially free. Ask about it. So there it is. Your complete dossier. Personal info, detailed vehicle specs, driver history, and your powerhouse list of potential discounts. It might seem like a lot of work, but this is the single most important step in the entire process. Spending 1 hour gathering this information will arm you with the confidence and the facts you need to turn the tables. You will no longer be a passive customer asking for a price. You will be an informed consumer, directing the conversation, ensuring every possible discount is applied, and demanding the best possible rate. Now that your file is complete, it's time to understand exactly what you're buying. In the next part, we're going to break down the confusing world of coverages, liability, collision, comprehensive, and all the add-ons so you know precisely what you need and what you don't. Alright, let's peel back the layers of this insurance onion. Think of it like this. You don't just walk into a restaurant and order food. You look at a menu and choose an appetizer, a main course, maybe a side dish. Car insurance is the exact same. You're not buying one single thing called insurance. You're building a custom policy from a menu of different coverages. And the most important item on that menu, the one the law requires, is liability coverage. Liability is the foundation of your entire policy. Here's the single most important thing to understand about it. Liability coverage does not pay for you. It doesn't pay for your car, and it doesn't pay for your medical bills. It pays for the damage you do to other people and their property when an accident is your fault. You are liable, so your insurance covers the costs for the other party. Let's play this out. Imagine you're driving home, you're tired, you glance down at your phone for just a second. A terrible idea, by the way, and bam, you rear-end the car in front of you. It's a brand new Audi. The driver gets out, clutching their neck. Your car is banged up, but you're okay. Now what happens? This is where liability coverage springs into action. It's broken into two parts. First, there's bodily injury liability. The other driver's neck is sore, they go to the doctor, they need physical therapy. Your bodily injury liability pays for their medical bills, their lost wages if they can't work, and even for their pain and suffering. Second, there's property damage liability. That brand new Audi you hit? It's got a crumpled bumper and a smashed taillight. The repair bill is going to be thousands of dollars. Your property damage liability pays to fix their car. It would also pay to fix a mailbox you knocked over or a fence you crashed through. Again, it's all about the stuff you damaged that isn't yours. Now, when you get a quote, you'll see a series of numbers like 50/100/50. This looks like a secret code, but it's actually simple. This represents your coverage limits in thousands of dollars. The first number, 50, means your policy will pay up to $50,000 for bodily injury to any one person in an accident you cause. The second number, 100, means your policy will pay a maximum of $100,000 for all bodily injuries combined in a single accident. So if you injure 3 people, the total payout for all of them can't exceed $100,000. The third number, 50, means your policy will pay up to $50,000 for all property damage you cause in one accident. Now here is one of the most expensive mistakes a young person can make. Every state has a legal minimum amount of liability coverage you have to carry. In some states, it's as low as 25/50/10, and it is incredibly tempting to just get the state minimum because it's the cheapest option. Do not do this. Let's go back to that Audi you rear-ended. The state minimum for property damage in many places is $10,000 or $25,000. A minor fender bender on a new luxury car can easily exceed that. What happens if the repairs cost $35,000 and you only have $25,000 in coverage? The insurance company pays its $25,000, and then the other driver's insurance company and their lawyers come after you personally for the remaining $10,000. They can sue you. They can get a judgment against you. They can garnish your future wages. For years, a piece of your paycheck could be going to pay for a mistake you made when you were 22 because you tried to save $12 a month on your insurance. Getting only the state minimum is like bringing a water pistol to a firefight. It's a gamble on your entire financial future. So, liability covers them. What covers you? This is where the next two crucial coverages come in: collision and comprehensive. Collision coverage is exactly what it sounds like. It pays to repair or replace your car if it's damaged in a collision with another object. That could be another car, a telephone pole, a guardrail, or even a curb you hit in a parking lot. It pays out whether the accident was your fault or not. If you slide on ice and hit a tree, collision has your back. If someone else runs a stop sign and hits you, you can use your own collision coverage to get your car fixed immediately instead of waiting weeks or months to fight with their insurance company. Comprehensive coverage is the other half of the coin. Its official name is other than collision, which is a great way to think about it. It covers damage to your car from almost anything that is not a collision. This is the coverage for all the weird random acts of life. A hailstorm leaves your car looking like a golf ball? That's comprehensive. A deer decides to play chicken with you on a country road? Comprehensive. A thief smashes your window and steals your stereo? Comprehensive. Your car gets stolen from your apartment complex? Comprehensive. A tree branch falls on it during a windstorm? You guessed it, comprehensive. Both collision and comprehensive come with a deductible. A deductible is the amount of money you have to pay out of pocket for a claim before the insurance company starts paying. They typically range from $250 to $2,000. Let's say you have a $500 deductible, and you have $3,000 worth of damage to your car. You pay the first $500, and the insurance company pays the remaining $2,500. A higher deductible means a lower monthly premium, because you're agreeing to take on more of the financial risk yourself. A lower deductible means a higher premium. So, do you actually need these two? If you have a loan on your car or if you're leasing it, the answer is yes. You don't have a choice. The bank or leasing company that technically owns the car will require you to carry both collision and comprehensive to protect their investment. But if you own your car outright, it's your call. The rule of thumb is to look at the value of your car. If you're driving a 15-year-old Honda worth $2,000 and your deductible is $1,000, you might be paying hundreds of dollars a year for a maximum potential payout of only $1,000. It might not be worth it. Okay, so we've covered their car and we've covered your car. But what about your own body? What if someone else hits you and they don't have insurance? This is terrifyingly common. About 1 in every 8 drivers on the road in America is uninsured. And many more only have that bare minimum liability coverage we just talked about, which won't be nearly enough if you're seriously injured. This is why you need uninsured and underinsured motorist coverage. Let me be clear. This is one of the most important and valuable coverages you can buy. It's your shield against irresponsible drivers. If an uninsured driver runs a red light and puts you in the hospital for a month, their lack of insurance becomes your problem. Your health insurance might cover the initial hospital bills, but what about the 3 months of work you miss? What about the long-term physical therapy? Uninsured motorist coverage steps in and acts like the insurance the other driver should have had. It pays for your medical bills, your lost wages, and your pain and suffering. Underinsured motorist coverage does the same thing when the at-fault driver has insurance, but just not enough to cover your bills. This coverage is typically very affordable, and skipping it is a massive risk. Closely related to this is medical payments coverage, or MedPay, and in some states, personal injury protection, or PIP. These cover medical expenses for you and your passengers after an accident, no matter who was at fault. It's fantastic because it pays out quickly, without waiting for the insurance companies to argue for months about who's to blame. It can cover your health insurance deductible, copays, or ambulance rides, ensuring you get the care you need right away. Finally, there's the dessert menu, the optional add-ons that can make life a lot easier. Things like rental reimbursement, which pays for a rental car while yours is in the shop after a covered claim. If you rely on your car to get to work, this is a lifesaver. There's roadside assistance, which can be cheaper than AAA and covers you for a tow, a flat tire, or a dead battery. And then there's one more I have to mention, especially if you're buying a newer car with a loan: gap insurance. When you drive a new car off the lot, it depreciates, meaning it loses value instantly. For the first few years, you will likely owe more on your loan than the car is actually worth. This is called being upside down. If your car gets totaled in an accident, your collision coverage will pay you the actual cash value of the car at that moment, not what you owe on the loan. So if you owe $22,000, but the car is only valued at $18,000, your insurance company hands you a check for $18,000 and you are still on the hook for that $4,000 difference to the bank. You'd be making payments on a car that is now in a junkyard. Gap insurance covers that exact gap. Pays off the difference so you can walk away clean. Phew, that was a lot, I know. But now you know the menu. You know what liability, collision, comprehensive, and uninsured motorist coverages are for. You understand the difference between protecting others, protecting your car, and protecting yourself. Now that you know what all these pieces are, we can start figuring out how much of each you actually need and, most importantly, how to get the absolute best price on the perfect policy for you. We're going to dive into the world of discounts, from good student to safe driver to the weird ones you've never even heard of. Alright, let's talk about the fun part. The part where you stop bleeding money and start playing the game to win. Discounts are not just little coupons insurance companies throw at you. They are the fundamental building blocks of a cheap, yet effective, policy. Think of it like a video game. The base price is the final boss, and every discount you find is a power-up. Your job is to collect as many power-ups as possible before you even walk into that boss battle. Let's start with the most obvious ones, the discounts you should be demanding if you qualify. First up, the good student discount. This is the insurance industry's way of saying, we've looked at the data, and apparently people who are responsible enough to get good grades are also responsible enough not to wrap their car around a telephone pole. And the savings can be massive, anywhere from 10 to 25%. The requirements are usually straightforward. You need to be a full-time student, typically under 25, and maintain a B average or a 3.0 GPA. Keep your report card or a transcript handy, because you'll need to send a copy to your insurer to prove it. Don't be shy about this. I knew a guy in college who saved over $400 a year just by sending in a PDF of his transcript. For $100 for grades he was already getting anyway. That's free money. Next up is the defensive driving course discount. This is another no-brainer. You spend one weekend or maybe a few hours online taking an approved defensive driving class. It might cost you 20, maybe $50. You get a certificate, you send it to your insurance company, and boom, they can knock 5 to 10% off your premium for up to 3 years. You do the math. A 10% discount on a $2,000 annual policy is $200. You spend $50 to make $200, and you get to keep making it for 3 years. That's a $600 return on a $50 investment. Plus, you actually learn some skills that might, save your life. It's a win-win. Now let's move into the discounts that require a bit more strategy. This is where we separate the amateurs from the pros. Let's talk about the big one, telematics. You've probably heard of this. It's also called usage-based insurance. This is where the insurance company gives you a little device to plug into your car, or has you download an app on your phone. And yes, it tracks your driving. It tracks things like how hard you brake, how fast you accelerate, what time of day you drive, and how many miles you drive. I know what you're thinking. I don't want my insurance company acting like Big Brother, watching my every move. And that is a totally valid concern. But let's reframe this. As a young driver, the insurance company's biggest fear is that you're a reckless stereotype. They see your age, and their algorithm just pictures you doing donuts in a parking lot at 3 a.m. Telematics is your chance to prove their algorithm wrong. It's your opportunity to raise your hand and say, hey, I'm not one of them. I'm a safe driver, and I have the data to prove it. If you're a genuinely good driver, you don't tailgate, you don't slam on the brakes, you don't treat every green light like the start of a drag race. This can be the single biggest discount you get. We're talking up to 30 or even 40% off in some cases. It turns your insurance from a fixed price based on demographics to a variable price based on your actual, real-world skill. It's the ultimate show, don't tell. And here's a pro tip. Most major companies that offer this have a trial period. You can try it for a few months, see what kind of discount they offer you, and if you don't like it, you can opt out. The best part? With most programs, your rate can't go up based on the data, it can only go down. You're taking a shot at a huge discount with almost no risk. While we're on the tech train, let's talk about pay-per-mile insurance. This is a different beast. If you're a student who lives on campus and your car barely moves all week, or if you work from home and only use your car for weekend errands, traditional insurance is ripping you off. You're paying as if you're a 15,000 mile a year commuter. Pay-per-mile flips the script. You pay a low base rate each month and then a few cents for every mile you actually drive. If you drive less, you pay less. It's that simple. For the right person, this isn't just a discount. It's a completely different and radically cheaper way of buying insurance. Okay, let's get into the life and loyalty discounts. These are about who you are and what you own. The most common is the multi-policy or bundling discount. You have car insurance. Do you also rent an apartment? You need renter's insurance. It's ridiculously cheap, like 10 or 15 bucks a month, and it protects all your stuff, your laptop, your TV, your clothes from theft or fire. Here's the magic trick. When you buy your auto and renter's insurance from the same company, they give you a discount on both. Sometimes, the discount you get on your auto insurance is so big that it makes the renter's insurance practically free. It's a financial cheat code. You get more coverage for less money. Always ask about the bundling discount. Next, think about all the groups you belong to. Are you a member of a fraternity or sorority? A college alumni association? A credit union? A professional organization related to your major? Many of these groups have partnership deals with insurance companies. They're called affinity discounts. You might get 5 or 10% off just for being part of a club you're already in. Go to the websites for every organization you're a part of and look for a member benefits or discounts page. You might be sitting on a hidden gem. And what about your car itself? Insurance companies love safe cars. Does your car have anti-lock brakes? Airbags? Of course. But does it have an anti-theft system? A VIN etching? Daytime running lights? Newer cars might have advanced safety features like automatic emergency braking, blind spot detection, or lane keep assist. Each of these can be a small separate discount, and they add up. Don't assume the insurance company knows what your car has. When you're getting a quote, have a list of your car's safety and anti-theft features ready and read them off. Every single one. Now for my favorite part, the secret menu. These are the discounts that most people never even think to ask about. First, the early shopper discount. Insurance companies have found that people who shop for their new policy a week or more before their old one expires are more responsible customers. So they reward you for it. Simply by not procrastinating, you can get a discount. Set a reminder on your phone for 2 weeks before your policy renewal date and start shopping then. It's that easy. Next, the paid in full discount. Most of us pay our insurance bill monthly because it feels more manageable. But if you can afford to, paying for the full 6-month or 1-year policy upfront can save you a surprising amount of money. Why? Because most companies charge you a billing fee or an installment fee of $5 to $10 for every single monthly payment you make. That's up to $120 extra a year just for the privilege of paying in installments. Paying in full eliminates those fees and often triggers an additional discount on top of that. Here's a really specific one for college students. The resident student discount, or student away at school discount. If you go to college over 100 miles from your home, and you don't take your car with you, you can get a massive discount. Your parents keep you on their policy, but you're listed as an occasional driver. The company knows you're only driving the car when you're home for holidays, so they slash the price. This can save your family a fortune. Finally, a few little ones that are just too easy to pass up. Paperless billing discount. You get your bills via email instead of snail mail. Boom, a few bucks off. Automatic payments discount. You let them automatically pull the payment from your bank account or credit card. Boom, a few more bucks off. These are tiny, but why leave that money on the table? So here's your mission. Before you get a single quote, I want you to do a full discount audit. Open a notebook or a new document on your computer and make a list. Title it My Discounts. Go through everything we just talked about. What's your GPA? Write it down. Are you willing to take a defensive driving course? Write it down. Are you a safe driver willing to try telematics? Write it down. Are you part of any clubs, alumni groups, or credit unions? List them all. Go to your car's manual or website and list every single safety and anti-theft feature it has. Are you willing to pay in full? Go paperless? Bundle with renter's insurance? Create a master checklist of every single potential discount you could possibly qualify for. This is your ammo. This is your battle plan. Because getting a quote isn't just about answering their questions. It's about telling them all the reasons they should give you a better price. Now you have your list. You know what you're worth. But how do you take this master list and use it to make insurance companies fight over you? How do you get quotes the right way, without getting confused by industry jargon and sales tricks? In the next part, we're going to arm you for that conversation. We'll cover the exact steps for shopping around, the secret questions you need to ask every agent, and how to compare quotes like a pro so you can spot the hidden traps and find the absolute best deal. This is where your preparation pays off. Alright, let's dive into the practical rubber-meets-the-road strategy for finding your perfect policy. The first thing to understand is that there are 3 main places you can get an auto insurance quote, and using a combination of all 3 is the ultimate power move. First, you have the online comparison sites or aggregators. These are the websites that promise to show you quotes from a dozen companies all at once. They are fantastic for getting a quick, bird's-eye view of the market. They give you a baseline, a general idea of what you should be paying. The downside? They don't include every single insurance company. Some of the biggest players don't participate, and sometimes the quotes aren't perfectly accurate because they use simplified data. Think of these sites as your starting point, not your final destination. Second, you have the direct carriers. These are the big-name companies you see on TV all the time. You go directly to their website or call their 800 number. The advantage here is that you're dealing directly with the source. The quotes are accurate, and you can often find unique discounts or policy features that the aggregators might miss. The obvious disadvantage is that it's time-consuming. You have to enter your information over and over again on each individual site. Third, and this is the one too many young adults skip, is the independent insurance agent. An independent agent is not tied to one single company. They work with multiple insurance carriers and can shop around on your behalf. This is a game changer. A good agent knows the market inside and out. They know which companies are best for drivers with your specific profile, which ones have the best claims service, and which ones have obscure discounts you'd never find on your own. Their service is free to you. They get paid a commission by the insurance company you ultimately choose. They are your professional advocate in this process. So what's the master plan? You're going to use all three. Here's your step-by-step process. Step 1. Gather your intel. Have that document we talked about ready: your driver's license number, your VIN, your estimated annual mileage, and the coverage levels you decided on. Having this ready will save you a massive amount of time. Step 2. Start with 1 or 2 major online comparison sites. Spend about 30 minutes here. Enter your information carefully and get a range of quotes. Don't fall in love with any single one just yet. Your goal here is to identify 2 or 3 companies that seem competitively priced for someone like you. Write them down. Step 3. Go direct. Pick 2 of the biggest carriers that you know of, maybe ones that didn't show up on the comparison site. Go to their websites and fill out their quote applications from scratch. Yes, it's a bit of a pain, but this is crucial for accuracy and for seeing what they can offer directly. Compare these quotes to the ones you got from the aggregator. Step 4. Contact a local highly rated independent agent. You can find one by searching online for independent insurance agent near me and looking at Google reviews. Tell them you're a young adult shopping for your first policy and that you've already done some research. Give them the coverage limits you want and let them go to work. This is like having a pro on your team. They might come back with a quote from a smaller, regional company with amazing rates and service that you would have never found otherwise. Now, as you start getting these quotes, whether it's from a website or a person on the phone, you need to shift from being a shopper to being an investigator. Do not just look at the final price. That's the rookie mistake. You need to ask the right questions to uncover what's really going on behind that number. Here are the secret questions you need to ask for every single quote you get. Question number 1. Can you please confirm line by line that these coverage limits and deductibles are exactly what I asked for? This sounds simple, but it's critical. Some agents or websites might lower your liability coverage or increase your deductible to make their price look more attractive. You must force them to confirm that you're comparing apples to apples. If one quote is for 25/50/25 liability and another is for 100/300/100, the cheaper one isn't a better deal, it's just worse coverage. Question number 2. What specific discounts have been applied to this quote, and are there any others I might be eligible for? Don't just assume they gave you everything. Ask them to list the discounts out loud. Good student? Defensive driving course? Multi-policy if you have renter's insurance? Low mileage? Sometimes a discount gets missed. Asking this question directly forces them to double-check and could instantly save you more money. Question number 3. What happens to my rate if I have my first at-fault accident? This is a huge one. Some companies have accident forgiveness for your first mistake, but the rules vary wildly. Is it included for free? Do you have to pay extra for it? Do you only qualify after being a customer for 3 years? A slightly more expensive policy with great accident forgiveness could save you thousands compared to a cheaper policy that will jack up your rates by 40% after one single fender bender. Question number 4. Are there any fees for paying monthly instead of paying the full 6-month premium upfront? This is a hidden trap. Many companies charge an installment fee of anywhere from $3 to $10 per month if you don't pay in full. A policy that looks $10 cheaper per month might actually be more expensive once you factor in these fees. Always ask for the total 6-month cost and the monthly breakdown so you can see the real price. Question number 5. What is your claims process like? Will I have a dedicated claims adjuster? Or will I be talking to a different person in a call center every time I call? Price is what you pay, but service is what you get. When you're in a stressful situation after an accident, the last thing you want is to be trapped in an automated phone tree. A company that boasts about its award-winning, US-based claims service might be worth an extra $15 a month. Okay, you've gathered your quotes, you've asked the tough questions. Now it's time to compare them like a pro. Don't just stack up printouts on your desk. Open up a simple spreadsheet. Create columns. The first column is the company name. The next 6 columns are for your core coverages: bodily injury per person, bodily injury per accident, property damage, uninsured motorist, collision, and comprehensive. In each cell, you're going to put the exact coverage amount for that company's quote. This immediately shows you if one company is quoting you lower liability limits. The next column is for your deductibles, one for collision, one for comprehensive. Again, they must be identical across all rows for a fair comparison. If one company quotes you with a $500 deductible and another with a $1,000 deductible, of course the second one will be cheaper. You're taking on more risk. Standardize this. Then have a column for the total 6-month premium. This is the most important number. Right next to it, a column for the true monthly cost, including any installment fees you uncovered. Finally, and this is the pro-level touch, have a notes column. In this column, you'll jot down the answers to those secret questions. Things like, includes first accident forgiveness, or claims handled by a dedicated agent, or high installment fee, or even your gut feeling about the customer service you received. Laying it all out like this on a single screen is a revelation. It transforms a confusing mess of numbers into a clear, logical choice. You'll instantly see which company is offering you the best protection, for the best price, with the best service features. The quote that looked cheapest at first glance might suddenly look like a terrible deal once you see the low coverage, high fees, and lack of benefits. And a quote that seemed a bit high might reveal itself to be the absolute best value, packed with protection that gives you true peace of mind. This methodical process removes emotion and marketing hype from the equation. It empowers you to make a decision based on cold, hard facts. You're no longer just buying a price tag. You're investing in a specific package of financial protection. You're in complete control. Now that you have this powerful comparison chart, and you've likely identified a frontrunner, the next step is to pull the trigger. But not so fast. The process of actually purchasing the policy and canceling your old one, if you have one, is filled with its own set of pitfalls. We need to talk about how to lock in your rate, set the correct effective date, and make the switch seamlessly without a single second of a lapse in coverage, which can be catastrophic. That's what we're breaking down next. Alright, let's get this done. You've navigated the jungle of quotes, you've deciphered the cryptic language of coverages, and you found the policy that gives you the protection you need at a price that doesn't make you want to sell your car and buy a bus pass. But holding a quote is not the same as holding a policy. A quote is just a promise, an estimate. The next few steps are where you turn that promise into ironclad protection, and this is, without exaggeration, the most critical phase of the entire process. One wrong move here can cost you thousands, even tens of thousands of dollars, and undo all the hard work you've just put in. First, you need to bind the policy. That's the industry term for making it official. This is the moment you go from shopping around to insured. You'll provide your driver's license number, the vehicle identification number or VIN of your car, and you'll set up your payment. This usually involves a down payment, which is almost always just your first month's premium. So if your quote is $100 a month, expect to pay that $100 right now to activate the policy. You'll likely sign some documents electronically, which is as simple as clicking a few boxes. Once you've paid and signed, the company will bind the coverage. You are now officially their customer. They will email you a confirmation, proof of insurance, and temporary ID cards almost instantly. This email is your golden ticket. Do not proceed to the next step until you have it in your inbox. Now let's talk about the single most important date on your calendar for this entire process: the effective date. This is the date and time your new insurance policy officially begins. Choosing this date isn't a random guess. It's a calculated, strategic decision. The golden rule is simple. Your new policy's effective date must be the exact same day your old policy's cancellation date. Not the day before, and absolutely under no circumstances the day after. Let's say your current policy with your old insurer expires or renews on July 20th. You want to set your new policy's effective date for 12:01 a.m. on July 20th. If you started on July 19th, you're paying for two insurance policies for a full day. It's called overlapping coverage, and it's like paying for two Netflix subscriptions. You only get to watch one at a time, so you're just lighting money on fire. It's wasteful. But the far greater danger, the catastrophic mistake, is leaving a gap. If you set your new policy to start on July 21st, you have created a 24-hour lapse in coverage. To an insurance company, a lapse is one of the biggest red flags a driver can have. It tells them you are irresponsible and high risk. That one-day gap will follow you for years, jacking up your premiums every time you shop for insurance for the next 3 to 5 years. It's a financial penalty that just keeps on taking. And that's not even the worst-case scenario. The true nightmare is what happens if you get into an accident during that lapse. Imagine it's July 20th. You're driving to meet some friends, completely unaware that you are For all legal and financial purposes, uninsured. Someone runs a red light and plows into your driver's side door. Your car is totaled. You're injured. In a normal situation, your insurance would be battling it out with their insurance, your medical payments coverage would kick in, your collision coverage would handle your car. But with a lapse, you have nothing. You are on your own. You are personally 100% financially liable for your own medical bills, the full value of your destroyed car, and if you were at fault for the other person's damages and injuries too. A single day of being uninsured can lead to bankruptcy. It can financially ruin you before your adult life has even truly begun. On top of that, most states have laws requiring continuous coverage. The DMV will be notified of your lapse and can hit you with fines, license suspension, and registration suspension. It is a cascading disaster that all starts with a simple mistake in scheduling. So here is the foolproof step-by-step protocol for switching insurance companies without a single second of a lapse. Follow this to the letter. Step 1. Purchase the new policy. Go through the entire process we just discussed. Pay your first premium, sign the documents, and get that confirmation email. This email is your proof. It should clearly state your policy number, and most importantly, the effective date you've chosen. Step 2. Download your new proof of insurance. Print out the ID cards and put them in your glove box. Save the digital version to your phone. Do this before your old policy is canceled. You want to be fully armed with your new documents before you make the final move. Step 3. This is the key. Only after you have received confirmation that your new policy is bound and active, do you contact your old insurance company to cancel. Never, ever cancel your old policy first, hoping the new one will come through. Hope is not a strategy. You must have the new policy secured before you cut ties with the old one. Step 4. Call your old insurer's customer service line to cancel. Do not assume you can just stop paying. This is the single worst thing you can do. If you just stop paying your bill, they won't simply close your account. They will cancel your policy for non-payment, which is a thermonuclear bomb on your insurance record. It's even worse than a voluntary lapse. It screams to all future insurers that you are a credit risk and unreliable. You must formally request the cancellation. When you call, be prepared. You'll likely be transferred to a retention specialist. Their entire job is to keep you from leaving. They'll ask why you're canceling, and when you say you found a better price, they will suddenly and miraculously find new discounts to try and match or beat the new offer. It can be tempting, but stand your ground. You've already done your due diligence. You found a better company for your needs. Politely but firmly say, "Thank you, but I've already secured a new policy, and I would like to proceed with the cancellation." You need to tell them the exact date you want the cancellation to be effective. Again, this should be the same date your new policy begins. If your new policy starts July 20th, you cancel the old one effective July 20th. This ensures a seamless transition. Before you hang up, ask for 2 things. First, a cancellation confirmation number. Write it down. Second, ask them to send you an email or a letter confirming the cancellation and its effective date. This is your proof that you ended the relationship properly. Finally, ask about a prorated refund. If you paid for your old policy in a 6-month or year-long lump sum, and you're canceling before the term is over, they owe you money back for the unused portion. They should automatically process this, but it never hurts to confirm. The refund will be sent to you as a check or a direct deposit within a few weeks. By following this exact order of operations, secure the new, then cancel the old, matching the dates perfectly. You create a perfect, seamless transfer of coverage. You're never double paying, and more importantly, you are never uninsured. You've successfully upgraded your financial protection, saved money, and avoided the landmines that trip up so many other people. You've now executed the plan flawlessly. You have a better policy, you've saved a significant amount of money, and you've made the switch like a seasoned pro. But your work isn't over. In many ways, it's just beginning. Insurance isn't a set-it-and-forget-it product. Your life is going to change, and your insurance needs will change right along with it. Getting a great rate today is fantastic, but keeping a great rate for the next 5, 10, 20 years is the real goal. What happens when you move to a new apartment, or get married, or buy a newer, safer car? Each of these life events is an opportunity to lower your rates even further, but only if you know how to leverage them. We need to build your long-term insurance strategy, ensuring you are always in the driver's seat. That's how we'll make sure you're winning the insurance game, not just today, but for the long haul. So let's build that strategy right now. Your long-term insurance plan isn't about some complicated financial document. It's about a mindset shift. You need to stop seeing auto insurance as a static, non-negotiable bill like your water or electricity. It's not. It's a dynamic, competitive market, and you are the prize. Your strategy is to consistently and intelligently make insurers compete for your business. This strategy has two key time frames: the 6-month check-in and the annual deep dive. Let's start with the 6-month check-in. I want you to pull out your phone right now. Seriously, do it. Open your calendar, go forward 6 months, and create an event called Review Auto Insurance. Set a reminder. This is the single most important habit you can build. Why 6 months? Because most auto insurance policies are 6-month terms. This is your natural opportunity to make changes without any hassle. During this check-in, you're not necessarily reshopping your entire policy, but you are updating your life with your current insurer. Did you get a new job with a shorter commute? That's a potential low-mileage discount. Call and tell them. Did you install an anti-theft device? Call them. Did you finally clean out the garage and now park your car inside? That's a potential discount. These seem like small things, but they can chip away at your premium. This 15-minute check-in ensures your policy accurately reflects your life, preventing you from overpaying for a risk profile you no longer have. Now for the main event, the annual deep dive. This is non-negotiable. At least once a year, you must reshop your insurance. This is where you fight back against something called the loyalty tax. It sounds crazy, but many insurers bank on your inertia. They know most people don't bother to shop around, so they might slowly creep up your rates year after year, even if you've been a perfect driver. They're rewarding your loyalty with higher prices. Your annual deep dive is how you defeat this. Here's your battle plan. 1 month before your policy is set to renew, you go into action. Step 1. Find your current policy's declarations page. This is your holy grail. It lists all your coverages, limits, and deductibles. Step 2. Using that exact information, get quotes from at least 3 to 5 other major insurance companies. Use the online tools we talked about, call an independent agent, do whatever it takes. You need to create a true apples-to-apples comparison. Step 3. Analyze the results. If you find a significantly better offer, fantastic. But don't switch just yet. Step 4. Call your current insurer. Tell them, "Hi, my policy is up for renewal, and I've received a quote from competitor X for the exact same coverage for this much less. I've enjoyed being a customer and I'd prefer to stay, but it's hard to justify paying so much more. Is there anything you can do to match or get closer to this price?" This is the power move. You are now negotiating from a position of strength, armed with real-world data. Sometimes they'll magically find a new discount you suddenly qualify for. Other times they won't budge. And if they don't, you walk. With your better offer in hand, you thank them for their time and you make the switch. It's that simple. This single annual habit can save you hundreds, if not thousands of dollars over just a few years. Beyond these scheduled reviews, your long-term strategy involves leveraging major life milestones. These are the big moments that fundamentally change how insurance companies see you. The first, and arguably the biggest, is turning 25. This is the magic number in the insurance world. Actuarial data shows a significant drop-off in accidents for drivers once they hit 25. You are statistically a safer driver. On the day you turn 25, your insurance doesn't automatically get cheaper. You have to be proactive. Call your insurer on your 25th birthday and ask for a re-rating. Many young drivers miss this and overpay for months or even years. Next up, getting married. To an insurer, a marriage certificate is a signal of stability and responsibility. Married couples file fewer claims than single individuals. This can translate into a substantial discount, sometimes as much as 10 to 15%. If you get married, don't just update your Facebook status. Update your insurance company. You can also look into combining policies with your spouse, which often provides even greater savings. Then there's the big one, buying a home. This is where you unlock the holy grail of insurance discounts, the multi-policy or bundling discount. When you bundle your auto insurance with a new homeowner's or renter's policy, insurers are ecstatic. They now have more of your business and you are seen as a more stable, rooted customer. The discount for bundling is often one of the largest they offer, frequently saving people 20% or more on both policies combined. 2 other milestones are more gradual but just as powerful. First, improving your credit score. As we discussed, your insurance-based credit score is a huge factor. As you spend your 20s building a positive credit history, paying bills on time, managing debt, your score will improve. Every year when you do your deep dive, that improved score can translate into a lower premium. It's a direct financial reward for your fiscal responsibility. Second is the passage of time on your driving record. Accidents and tickets don't haunt you forever. Typically, a minor ticket will stop affecting your rates after about 3 years, and an at-fault accident will be removed from consideration after about 5 years. Know these dates. If you had a fender bender when you were 21, the year you turn 26 could be when that accident no longer counts against you. That's a massive leverage point to demand a lower rate or shop for a much better one. Your entire journey as a young adult is a story of decreasing risk. You're getting older, more experienced, more stable, and more financially responsible. Your insurance premium should reflect that downward trend. But it will only happen if you are the one telling the insurance company that your story has changed. Now let's put it all together. You are no longer just a driver paying a bill. You are the CEO of your own risk profile. Your job is to manage that profile and ensure you're paying a fair price for it. You do this by conducting regular check-ins, performing an aggressive annual review, and capitalizing on every single life event that makes you a better customer. This is how you win. You don't win by finding one magic bullet cheap company. You win by building a system, a process, a set of habits that keep the entire insurance market constantly competing for your business year after year. You've made it through this entire guide. You started likely feeling overwhelmed, maybe a little confused, and probably overpaying. Now you have the complete playbook. You know what coverages mean, you know where to find hidden discounts, you know how to compare quotes like a pro, and now you have a long-term strategy to keep those savings for life. You have transformed from a target for high premiums into a savvy, informed consumer who is in complete control. The power has shifted from them to you. Insurance is no longer something that happens to you. It's a financial tool that you now know how to wield effectively. So what's the next step? It's not to go memorize everything we just talked about. The next step is to take one single action. Just one. Right now, after this video ends, either go find your current policy's declarations page, or set that 6-month reminder in your calendar, or get just one competing quote online. That's it. That small 10-minute action is the first step on this new path. It's the first domino to fall that will lead to thousands of dollars in savings over your driving life. You have the knowledge. You have the tools. You have the plan. The only thing left is to execute. Stop letting insurance happen to you. Start making it work for you. Take the wheel.